Probably heard of inflation, but don't know the definition of a term called stagflation. Stagflation is at risk in the US, and this has a huge impact on the ability to make business decisions. And we'll use Best Buy as an example of how the potential stagflation can hurt profitability. So here's a headline from the Wall Street Journal. The two-headed monster stalking the economy has a name, stagflation. And this relates to the tariff issue. Tariffs have stoked fears of a jury combination of weak growth and inflation. So, inflation you probably know as too many dollars to issue too few goods. We have too much demand. We have a limited number of items, products or services that people want. That drives up the price of those products or services. Stagflation, on the other hand, is a combination of inflation, but not with the higher level of growth that would normally drive inflation. So let's scroll down here. So it mentions the tariffs, particularly the tariffs on Canada and Mexico. And another thing to remember here is that companies crave certainty. The more certainty they have, the more accurately they can plan sales, profits, and costs. So this is disruptive because the fact that you might get a tariff on a component part or on a product that you import is disruptive to your planning process. So this quote here from Prudential, these tariffs will be inflationary. They will be a real shock to real household income, just as household income growth is slowing because of slower employment and wage gains. So we're in a situation here where the economy may be slowing. Then you throw on top of that people are going to pay more for products and services. And if you scroll down here a little bit further, you see a quote, China and Mexico are top sources of customer electronics sold at the retailer Best Buy. And the chief executive officer says, we expect our vendors across an entire assortment will pass on some level of tariff cost to retailers, making price increases in the U.S. highly likely. So let's use Best Buy as an example to talk about the struggle to maintain profitability in this situation. If you want a good snapshot of a company's financials, I like Yahoo Finance. So this is Best Buy, publicly traded company, and I'm going to scroll down to some financial highlights here. So let's think about profitability, profit margin, which is simply net income divided by sales. How much do you make on every dollar of sales? It's 2.23%, which is a pretty narrow margin. So they don't have a lot of room for error when it comes to generating profits in their product. Return on assets and return on equity are important. Let's go a little bit further down. Gross profit, which is the difference between revenue and cost of sales. So if tariffs go higher, that cost of sales number may go higher as well, which reduces your gross profit. We see gross profit. Here's the hard gross profit number, 9.38 billion on revenue of 41 billion. So this gross profit number is at risk if we have a tariff situation and costs go up, because cost of goods sold will be higher, revenue less cost of goods sold, gross profit will be a lower number. And finally, let's not forget about cash. In a slowing economy, if sales slow, they have less cash. They have less cash, and they're in a stagflation environment where costs are going up. They may need to use more and more cash to pay cost of sales, even though cash inflows are slowing because of lower sales. So these are some of the challenges that Best Buy can face. And now the question is what to do about it. Finally, let's take a look at what Best Buy can do about the potential of higher tariffs and higher costs by looking at the break-even formula. So this is the break-even formula: profit, sale price times units sold, less variable cost times units sold, less fixed cost, which is a fixed amount of dollars. So here's the formula. I've got the formula built into this analysis. Let's say we're talking about Reese's peanut butter cups. So sale price of 5, variable cost of 3.2, fixed cost 2,850,000. That's a fixed number. And we sold 2 million units. We can come up with total sales, units times units sold, variable cost times units sold. In red, fixed cost, that number just transfers down. It doesn't change, and we come up with a target profit. So in the scenario with Best Buy, your variable cost, which is your cost of goods sold, may be going up because you're paying more for items you're importing due to tariffs. So what could you do to maintain the $750 profit? Let's say that variable costs go up to 3.8 from 3.2. Now you're operating at a loss. Well, you can raise your prices. Let's make it 6. That could be pretty challenging, particularly in an environment like consumer electronics where you have heavy competition. So maybe that's not a possibility. Let's make it 5.8, even lower. Maybe you find ways to cut other variable costs that you incur. So if you're paying more for products coming in, you cut costs somewhere else to hold this variable cost number down. Maybe it's down to 3.6. Again, the other issue with stagflation is you're selling less. So not only are your costs going up here, you may be selling less here. So what if your unit sales go down? That also has an impact. So the bottom line here is that higher variable costs and lower units sold due to stagflation, which we haven't had happen since the 70s, could have a real impact on maintaining profitability and make it very difficult for U.S. business managers to make decisions to maintain profit. If U.S. countries actually have to deal with stagflation, they may face slowing sales and higher prices, which is going to make it very difficult to maintain profitability. And companies are going to have to make hard choices in that environment.